But there's also a lot of Main Street impact here from the Fed's move that must not be ignored. We're going to talk about that as well. Joining us, Yahoo Finance Editor-in-Chief Andy Serwer and our Fed reporter Brian Cheung, coming straight from Washington back here to New York to talk to us about all this. So, Brian, let's start with you and what we heard yesterday and what perhaps was surprising to you and to markets, if anything.
Yeah, well, it was a whirlwind Wednesday. I still need some of those energy mints, by the way.
Happy to help.
But basically, the big story and takeaway from the Fed was that they did follow through on that 75 basis point, 0.75% interest rate increase. That's the largest single move that we've seen in a meeting since 1994. And the big reason is because of downgrades, if you will, on where the Fed expects to see inflation over the next year. They upgraded their expectation for where they could see inflation clocking in over the course of 2022, and that's the reason why they had to go with a larger outsized hike in that meeting, despite the fact that they were messaging for the 5 weeks prior to that they were going to do a 0.5 percentage point hike. Now, the Fed commentary from the chairman, Jerome Powell, at 2:30 yesterday was essentially that they have flexibility going forward, that the next stop is not going to be 100 basis points in the next meeting in July. He said that conversation is more likely going to be the debate between 50 and then 75. Of course, after the pivot that we saw from them, why should we hold any water into that, I think is a natural question. However, Fed chairman saying, look, even though we have that discussion over 50 versus 75 for July, anything could happen. They're going to be data dependent. They want to have the flexibility going forward.
And so people just want to know how this move impacts them at the end of the day, whether they're saving for a house, whether they're just saving in general, and what comes next for them in a rising rate environment now.
Yeah, I mean, so a couple things. First of all, from an investor standpoint, we saw the market go up yesterday, which maybe speaks to the fact that people were happy that the Fed is flexible and on the case. On the other hand, now today, markets are looking ugly, so maybe they're suggesting that, wow, the Fed actually sees the economy needing more help than previously thought. So half full, half empty. But getting back, Brad, to the consumers, you know, what's going to happen is that you're going to see interest rates rise on mortgages. And in fact, we've already seen that rather dramatically. And that you can see that right there on the screen. I mean, you know, going back 6 months ago, these are, you know, hundreds of basis points moves on these securities. And if you're looking to buy a house, that's rough. So you get hurt there. Well, I'm going to get some help on my savings account, right? Not so fast. Because the banks like to make money both ways. They make money off you with mortgages by raising them really rapidly. But then when it comes to your savings account, they're not going to raise it so fast. And in fact, I was just looking last week, the average national rate on a savings account, according to bank rate, 7 basis points,
well,
0.007.
I guess it's better than...
Well, it was even lower. Yeah. I mean, and I talked to some people at a large institution, and they were telling me that, you know, they were losing money on these things by paying people 3 and 4 basis points.
I was going to say, and this chart is really interesting, that personal savings rate that we just showed, because you've actually seen that the rate right now is lower than it was pre-pandemic. Why is that happening? Well, it's because right now people are spending, and obviously higher prices are forcing them to tap deeper into their savings. Although this is a rate, not a level, right? The amount of savings in totality actually went up through the pandemic because of the amount of stimulus, those checks that went out to households. So they have a larger buffer to burn through. But to the point about how much money do people want to put into their savings accounts right now, I don't know if a few basis points is going to incentivize people to say, oh, well, you know what? I'll just choose to save more money in the bank because, look, the prices at the store for the things that they have to buy, like eggs or gasoline to put into their cars, are getting higher.
But then there are people, Brian, who are making this decision. Do I want to lose more on my Netflix stock, right? And because this is down 60, 70%, or, you know, get 7 basis points of cash, at least I'm not losing my capital.
Andy, you mentioned housing, and just moments ago, we just got housing starts for May. They were down in the U.S. 14.4%. Before, really, we're starting to see the full impact of some of these rate hikes from the Fed. But, Brian, look, a lot of folks are waking up this morning. They're wondering, why are stocks getting slammed here? That wasn't the initial reaction. A lot of notes I'm seeing are now raising the potential for a hard economic landing, and that necessarily wasn't on the cards pre-Fed meeting.
Well, I do think we have to recognize that what the Fed did yesterday is actually in some ways a position of strength for the central bank, from the position that they have the ability to raise interest rates more aggressively because they don't have to worry about their Forex implications of raising rates. I think what you're seeing today, but just this morning, right, the Bank of England deciding to go by 25 basis points, even though a decent split among the Monetary Policy Committee about maybe wanting to go for a more aggressive 50 basis point hike. You saw the Swiss National Bank make a surprise interest rate hike of a half a percentage point, which they haven't done, by the way. They haven't raised interest rates in 14 years. What's the reason for all of that? They need to defend their currencies. That's the reason why you're seeing the Great British Pound go up. That's the reason why you're seeing the Swiss franc go up, because they need to make sure that they're not going to devalue as the Fed raises interest rates. That's going to make more flows go into U.S. dollar-denominated assets. For the Bank of England, they are experiencing high inflation too, but they did not want to go for 50 basis points because they are worried that that's going to tip them into even more negative GDP growth. They already forecast after this 25 basis point hike this morning that they're going to have a contraction in their economy. Obviously, that a little bit more linked to the Russia-Ukraine situation, but Fed's not necessarily in that type of situation.
And speaking of that contraction, Brian, and what you were saying about a hard landing, Brian S. I, in my 40 plus years of covering financial markets, I have never seen a time where people are so certain that we're going to have a recession. I mean, I just can't remember it. And usually the thing that bites you in the you-know-what hardest is something you don't see coming. And so I don't know what that means. I'm just putting that out there, that, this is not a black swan. This is not, the housing crisis, 2008, when 4 people in The Big Short saw it. This is not 1987, just like appeared. This is not 2000. Now there are some warning signs there. But like everyone knows, there's going to be a recession coming up.
Well,
really?
that was my question to Jay Powell yesterday.
Yeah.
Was the general vibe check, if you will, among households is that they're seeing what's happening at the store. They're worried about the purchasing power of the income that they have, right? Everyone's talking about a recession at the dinner table. Now, whether or not that's a self-fulfilling prophecy is an open question. It's not a done deal that we're in a recession right now. But my question was, the Fed is projecting that economic growth is still going to be coming okay. Inflation's going to come down as the Fed raises rates to about 2.6% next year, 2.2 in 2024, and that the unemployment rate's only going to tick up to, 3.9%. That would be a soft landing for them, but that's not what Americans are feeling or expecting when you look at inflation expectations, consumer sentiment. So there's this divergence happening between perhaps what the Fed sees as aspirational in their forecast and what Americans are experiencing in the household. And that gets to Andy's point. That's going to be a really difficult gap to try to close for policymakers.
Well, what's interesting is the gap that has closed and did close yesterday is that the Fed finally seemed to catch up to the market. In other words, as much as there is hand-wringing about soft landing versus hard landing, it felt like market participants were pushing the Fed to be more aggressive. Economists were saying they need to come in here and be more hawkish and try and slow inflation down. And they did that. And we're seeing Fed funds futures pricing, or the Fed sort of catch up with Fed fund future pricing in some way, right?
Right. So, and the expectations for Fed policy going forward actually, as you mentioned, did kind of close a little bit, because you had a lot of houses on Wall Street calling prior to yesterday's meeting for a more aggressive rate path than the Fed was saying prior to yesterday anyway. Now, that, though, is a completely separate discussion and doesn't bake into the commentary or the narrative about whether or not we're going to hit a hard landing, right? Because you can expect the Fed to get to 3.4% by the end of this year, and that doesn't necessarily mean one way or another that's going to lead to a massive spike in the unemployment rate or not. That's a whole separate thing, and I think that's largely what people are worried about.
And just quickly, you wonder how susceptible Jay Powell and company are to those voices, to Larry Summers, to Mohammed El-Arian, and all these very prominent people out there saying, you're behind the 8 ball, you're behind. I mean, we're data-driven, but we're also voices-driven.
It's a good point.
Vibes-driven.
Vibes-driven,
Yes.
right?
Great chat, guys. Yahoo Finance Editor-in-Chief Andy Serwer, our very own Brian Cheung as well. Really home run yesterday on your coverage. Good to see you back here.
Thanks so much, guys.